Amish, great to have you back. It's been a good July and August start has been decent. We've registered a double-digit gain from the recent low, and the returns in July have been nothing sort of record breaking. Where do we go from here? Do you think markets are now priced to perfection, or this market still has some more headroom left?
Sure. Good morning. Thanks for having me on your show, Nikunj. Nikunj, I have slightly divided views. So as far as the headline index is concerned, we are cautious. Especially, we see earnings risks for sectors which are external facing. And if the earnings for those sectors were to get downgraded, valuation multiples for the whole overall market may look subdued as well. But on the other hand, we think that the domestic cyclical sectors will do pretty well. So spaces like financials, industrials, some pockets of autos is where we are quite bullish at this point in time.
Let's understand that. Why you have a cautious or a slightly not a bullish view on the index? Is it largely because of the composition of the index, or you worry about macro earnings and valuations?
So most of my concerns are global macro-led. While I agree that at the margin things have been improving recently, but I think that the full-blown impact of what we talk about, the global growth slowing down, is yet to reflect in earnings. So take for instance, we started ourselves, the estimate for US GDP growth at the beginning of the year, we were talking about 4%. We have now brought it down to 1.1%. We are now talking about the certainty that US will head into a mild recession beginning fourth quarter of this calendar year, and the probability of it turning into a full-blown recession is only increasing as we go along. We've seen the data come out of Europe, China, Japan. They're all very weak. On the back of that, we're already seeing signs of export data weakening. So I think as we go along, there are quite a lot of external facing sectors, call it IT, call it materials, some pockets of autos, industrials, which derive substantial revenues, linked to what happens in the global economies. And that side of the market concerns us. We think that the full impact of that is not reflected in earnings and may pull the market overall down.
Sure. That's the thing, Amish, that even in this recovery that we've seen play out in the last 1 month or so, the fact that FIIs are back, there's a big sectoral churn which is taking place. Autos have made a humongous comeback. PSU banks have been performing, whereas the other traditional sectors have been taking a beating, so to speak. And of course, FMCG has been the darling of late. But just wanted to understand what is the right portfolio strategy? What are the sectors that you should be exposed to, and what are the sectors where you should be, which you should be completely avoiding at this juncture?
We could look at this in different ways, but to simplify this, we think domestic cyclicals and defensives is ideally the portfolio that I would build. Domestic cyclicals because there are tailwinds in favor of India right now. India is also relatively doing much better in comparison to other EMs, or maybe even in relation to developed countries as well. And that economic momentum, I think, will continue in favor of India. And in fact, as the global growth slows down, that brings down commodity prices, including crude, which will also work in favor of India. So I think anything which is focused on domestic growth stories, you yourself mentioned about banks, industrials, FMCG, all of these sectors I think are domestic focused and they will continue to do well. But at the same time, I would not be exposed to anything which is external facing, call it IT, materials, energy. These are sectors that do worry us. And to some extent, we are also cautious on the consumer discretionary, not the entire space, but pockets of consumer discretionary, because there we think that the valuations as well as earnings expectations are full up.
when you say defensives, Amish, considering you've already excluded IT out of that basket, I mean, do you mean FMCG and pharma? And I ask this because, again, pharma has a global linkage. We all know the US pricing pressure is back to haunt us. So is US FDA's magnifying glass. And even with FMCG, I mean, that has the most direct linkage to inflation.
Absolutely. Yes, I do mean FMCG. I will throw in power utilities as a sector which we consider defensive. And then healthcare, while we are positive on some stocks, it's not as if that we are positive on the whole sector, but one can identify certain stocks within there where the risk of FDA inspection is relatively low. There is earnings momentum. They are doing a lot on the cost front. Margins are expanding. Specialty businesses are doing well. So there are certain stocks that we like within the pharma space, and we will use that as defensives. But power utilities, FMCG put together, that could be a reasonable defensive portfolio, even if you keep IT out of it.
Okay, so you want to build a defensive cyclical portfolio, having more exposure to what's happening within India. So there, Amish, can I ask you what you would do then with the metal stocks? Because there is, of course, a global linkage when it comes to pricing, but just seeing the government capex, India Inc.'s capex program, we're calling it the Mahakumbh for capex as well. How should one look at that? Because it's so important when it comes to construction, infrastructure, etc.
Absolutely. So, first of all, we are very bullish on the capex cycle. Generally the capex cycles are fairly long, everywhere in the world, but especially in the context of India. We've generally seen that the cycles last around 9 years. And we think that the upcycle has just started. Over the next couple of years, we are in the camp that it will continue to be driven primarily by the central government capex. But as we go along over the next couple of years, we think that PSU capex, state government capex, even private capex towards a fag end will continue to add to the story. And over time, so if I were to fast forward 2 years, I think a lot of economies globally, as they move out of demand stimulus and try to still stimulate their economy, they may move to supply side stimulus, which is doing more capex, and that might create opportunities even for exports over time. So short point from now to the next couple of years, we think something or the other will keep getting added to the entire capex story. And this is important because historically we have seen that from a down cycle to an up cycle, this is a sector where margins double, working capital falls to 1/4, and as a result of those two, your return ratios triple and then valuation multiples quadruple. So tripling of earnings and quadrupling of valuations is really the big deal. Obviously, a lot of things have to fall in place, and this kind of returns one could expect over an entire cycle of 9 years that I'm talking about. And we may not go back to the full potential of 12 times, but the point here is that the cycle has just turned. We are in the early part of the cycle. There is a lot of returns to be made. The cycle will continue to gain momentum, and that makes us bullish. However, that said, I will reflect that view by being bullish on financials, industrials, to some extent even cement. At this juncture, we are not that bullish on steel because we do think that steel may continue to see price erosion, and given that it's a commodity sector, small price changes can have a meaningful impact on earnings. So not yet in the camp of being bullish metals.
Okay, so not bullish on metals, don't like steel, you're betting on cement, infrastructure and financials. You've said financials at least 3 times. So let me get into more details with that, Amish Shah. When you approach financials and you're talking about how the infrastructure play can lead to quadrupling of valuations, banks, NBFCs, financial sector will play a large role. So for financials, what is it that you're doing for your portfolio? Is it private sector banks, public sector banks? Are you looking at the mid-tier banks as well? Because you've seen a run up there as well.
Sure. By and large, right now we are bullish everything financials, but obviously depending on the beta that one wants to build in their portfolio. We think that even the large private banks are quite cheap, and they will therefore give modest returns but with low risk. If somebody wants to chase high beta and look for a little high risk, high growth, high returns, then I would look at mid-sized banks and even public sector banks. But just to put into perspective, at this point in time, broadly speaking, we are bullish everything financials.
How much of your bullish thesis in some of the consumer, some of the industrials, names like ABB, Siemens, is already in the price? Because what you've laid out is the perfect bull market cycle for us. Recovery will start, return ratios will expand, and also P multiples will go through the roof. But Siemens is already at a lifetime high. L&T has done rather well for itself. ABB is also outperforming quite smartly. So the thesis what you've laid out, how much of that is already baked in?
Sure. So the way I would look, think about this is that if the view is 6 to 12 months, perhaps you're right that the near-term upside is captured and the stocks may consolidate. But if you really believe in what I argued, that there is a 9-year cycle coming forward, then I think these stocks can deliver very good returns over time. So if for anybody trying to build a 3-year, 5-year, 10-year portfolio, I will still like to be bullish industrials. And that is coming back to the argument that I made, that over the cycle, earnings earnings growth really triples or quadruples, and that is a factor of your margins doubling, working capital cycle coming down, utilization levels picking up. So the valuations that we are looking at these stocks today is mostly the down cycle earnings. Remember, between 2012 to 2020, we were in a down cycle. So it's just a start of an upcycle. There's a very little delta that has yet come in terms of earnings. And on that earnings, the valuations look expensive. But as earnings keep on getting upgraded with margin expansion and working capital improvements, etc., then I think that the valuations for these stocks are not necessarily expensive. So in short, for a short-term view, maybe they will consolidate. But if you're looking for a long-term view and want to play the whole cycle, we will continue to be bullish.
The thought on cement. Now, one is the usual demand-supply dynamics, which we always consider before judging it. But now there is a new entrant dynamics. The fear is that now you've got a new entrant, and there's a big entrant in the cement space. Could there be a price war? If there is a price war, it is never good news for shareholders. Is that the biggest overhang and fear in cement now?
Sure it is, and to some extent I would say that that risk has already got priced in the valuations as well. We are currently more neutral weight on cement at these valuations. So again, splitting between the short term and the long term view. So near term, I agree with you that there are headwinds. There is still the coal prices in the region continues to be high. The diesel prices continue to be high. So these are cost headwinds. There is also the risk of price war and the new entrant, as you speak about. So near term, we do think that the sector may go through some more correction, which is why we are neutral weight. But when I was talking about a long-term capex cycle thesis, cement we think will participate in that rally too.
On that note, Amish, great to have you on the show. We'll let you go on that note.